In today's video, I'm going to show you 4 tax strategies that you can use if your money is locked up in pre-tax IRAs and 401ks, and nobody's talking about this. Not using the strategies that I'm going to show you could result in over $250K in taxes gone forever. As William James once wrote, the great use of life is to spend it on something that will outlast it. And while most people interpret that as a call to legacy, to build something meaningful that survives you, I would offer a different application for those of us who are thinking about retirement planning. A great mistake of financial life is to spend it deferring spending, deferring enjoyment, and yes, deferring taxes, without ever asking what that deferral is for and what it's actually costing you on the other end. Take someone who retires at 65 with $1.2 million, all of it in a traditional IRA. On paper, they look comfortable. But between Social Security income, required minimum distributions starting at 73, and the ordinary income tax owed on every withdrawal, they could easily face an effective tax rate of 22 to 24% on the bulk of their savings year after year to the last syllable of their recorded time. And for many retirees, later, that arrives at the exact moment that their income is fixed. Their flexibility is limited and the IRS is right on schedule, ready to take their pound of flesh. So, in today's video, I'm going to talk about what you can do when that Faustian bargain is about to come due, and how to negotiate better terms before it does. I'm John Norberg, certified financial planner and founder of Norberg Wealth Management, and I'd like to welcome you to this latest edition of the Financial Prof Series. So first, let's be clear about something. If you're sitting on a large pre-tax balance, you didn't make a mistake. The system rewarded you with tax deductions every year you contributed, with employer matches, with decades of tax-deferred compounding. You did exactly what you were told, and the issue isn't what you built, it's that you built only one kind of thing. In financial planning, we talk about tax diversification, spreading your retirement income across pre-tax, post-tax, and taxable accounts, so that no single tax treatment dominates your cash flow. Most diligent savers arrive at retirement with the pre-tax bucket overflowing and the other two nearly empty. I see it in my practice all the time, and this imbalance has consequences. So let me show you what that default path looks like if you do nothing. At age 73 or 75 for those born in 1960 or later under the Secure 2.0 Act, the IRS requires you to begin taking required minimum distributions, RMDs, from your pre-tax accounts, whether you need the money or not. Now, on a $1.2 million IRA, that's roughly $45,000 to $50,000 per year in forced taxable income. Now add Social Security, say $28,000 per year. Suddenly, your provisional income is pushing past the threshold where 85% of your Social Security benefits become taxable. You're not just paying taxes on your IRA withdrawals, you're paying taxes on income you assumed was straightforward, and it can be a surprise if you're not ready for it. Now layer in Medicare. Those same RMDs can push you over the IRMAA, that is income-related Medicare monthly adjustment amount. Now, those thresholds will trigger surcharges that add potentially thousands of dollars per year to your Part B and D premiums. Thousands more simply because of an account structure, not a lifestyle. And if you lose a spouse along the way, it gets even worse. You're likely to fall into what's known as the widow's tax bracket, meaning that the same income that you have been drawing suddenly jumps into the single tax bracket, whereas you had been used to the married filing jointly bracket before, jumping what you're now paying to the IRS year after year and not through any fault of your own. So what can you actually do? Well, here are 4 moves ordered from the most accessible to the most sophisticated. Strategy number 1, use the pre-retirement window for Roth conversions. The years between now and when you start drawing Social Security are oftentimes the lowest income years of your financial life. This can create a golden window, a period where your tax bracket is temporarily suppressed and Roth conversions can be done efficiently. Consider Peregrine. He's 61 years old, planning to retire at 63, with $950,000 in pre-tax accounts. He'll delay Social Security until 67 to maximize his benefit. That gives him a 4-year window where his only income is a small part-time consulting gig, which puts him squarely in the 12% bracket. If he converts roughly $55,000 to $70,000 per year in that window, he moves roughly $250K out of pre-tax territory before RMDs begin, without triggering IRMAA, without crossing into the 22% bracket, and without disrupting his cash flow. He does not convert everything. He doesn't need to. He just converts strategically, filling that bracket without crossing it, and it meaningfully changes the shape of his tax exposure in the years ahead. Strategy number 2, pair your Roth conversions with charitable giving. Now, if you're charitably inclined, this can boost the impact even further. A donor advised fund, for example, can dramatically reduce or even eliminate the tax cost of a Roth conversion by generating a large, immediate deduction to offset the conversion income. We covered this strategy in depth in a recent video, so I won't repeat the whole walkthrough here, but it can be a very powerful way to offset or again, even eliminate entirely those Roth conversion taxes that you might be afraid of. Strategy 3, future contributions going into Roth while you still can. Now, this is for those of you who still have years left in the workforce, and may be the simplest, highest leverage move of all. Meet Lewis and Zaley, both 57, both still working and contributing the max to their traditional 401ks. They feel a bit behind as Zaley stopped working for a time to raise the children. They have 820k all in pre-tax, and like many people in their position, no Roth or anything else besides that. Now, there's one more thing worth knowing about Lewis and Zaley. Longevity runs deep in both families. All of their parents lived past the age of 90, so planning for a 30-year plus retirement is just reality. Their advisor tells them to keep doing what they're doing. Max the traditional 401k, get the tax break now, worry about the rest later. But here's what later looks like. Their IRA is projected to grow by 1 to 1.4 million by the time RMDs kick in. At a 4% RMD rate, that's 56k per year and growing in forced taxable income, stacked on top of Social Security, potentially triggering IRMAA and leaving them with almost no tax flexible income. And remember, longevity means they're going to have 30 plus years of retirement life. So instead, Lewis and Zaley make a different choice. They switch their contributions, which they now make it about 30k per year combined, entirely to Roth 401k. Now there's a trade-off, and it is a real one. By choosing Roth, they give up that tax deduction, which we can assume is about 22%, roughly $6,600 per year in tax savings they're walking away from. Over 8 years, that's about 53k in foregone deductions. That's not nothing. And for someone in poor health or with a shorter family history, it might be the wrong trade-off. But for these two, the math tilts the other way. First, the 53k is not lost, it's prepaid. Every dollar they put in the Roth will never be taxed again, right? And secondly, their 820k pre-tax balance is already large enough to generate significant RMDs on its own. They might not want or need to keep feeding it. And third, and most importantly, by retirement, those Roth contributions are projected to grow to roughly 280k over this 8 years, and that's completely tax-free, which they can then use to manage their higher expense years if they need to. And for a couple likely to spend 30 plus years in retirement, the difference between a tax diversified portfolio and an all pre-tax one isn't just convenience, it's potentially 6 figures in avoidable taxes over the arc of their retirement. That's why this is definitely worth considering if this sounds like you. Now, strategy number 4 is building a taxable brokerage as your third bucket. This is often overlooked. It's a plain, ordinary taxable brokerage account with no contribution limits, no RMDs, and it's taxed at 0, 15, or 20% instead of ordinary income, which is oftentimes a higher rate. So if you're still working and you've maxed your retirement accounts, consider redirecting some additional savings into low-cost index funds in a brokerage account if that fits your risk tolerance and your needs. Even $1,500 to $2,000 per year over several years can build a meaningful reserve of money that's very tax advantaged, especially if you manage capital gains and losses, particularly during market volatility. So if you're watching this video and you've recognized yourself maybe in one of these scenarios, I would encourage you to go ahead and click the link in our description and fill out a few key questions, and I will send you a free 5-minute retirement plan video personalized to those numbers that will help you see where you stand and give you some actionable insights that you can take away and hopefully implement in your own situation if it makes sense to do so. Again, the link is in the description. Go ahead and click it. I'll be here when you get back. All right, so how do you prioritize where to start? Here's a simple framework based on your timeline. If you're 10 or more years from retirement, time is your most valuable asset. Focus on redirecting future contributions into more tax-advantaged accounts, be it Roth or a taxable brokerage. The compounding advantage of acting early is enormous. If you're 5 to 10 years out, consider beginning modest Roth conversions now. Map your income trajectory, identify your low tax windows, particularly if your job has variable income, and start shifting that balance thoughtfully and incrementally. If you're within 5 years of retirement or already there, conversions are still possible, but they require precision. You need to model your RMDs, your Social Security timing, and your IRMAA exposure carefully before acting. And don't forget about the 5 year rule. This is where it becomes incredibly important to work with a professional to map all of this out and make sure you don't fall into any of the Roth traps. And we here at Norberg Wealth Management specifically specialize in these kinds of Roth conversion strategies. So, let me go ahead and bring this right back to where we started. William James was right that the great use of life is to spend it on something that will outlast it. And for most of the people watching this, that is exactly what you did. You built something very real. You deferred, sacrificed, and compounded over time, and the balance is the proof. But there are two phases to a financial life: the building and the spending. And what works beautifully in one phase can quietly work against you in the other. As Ecclesiastes tells us, there is a time to sow and a time to reap. And it's worth remembering that the point of the sowing wasn't necessarily just the sowing itself. Life, after all, is not meant to be just one great fast with no feast. The harvest exists to be enjoyed. And that's exactly what these strategies help you to understand and hopefully begin to do. You spend 30 years filling the bucket, and the question now is how wisely you empty it. And again, if you're not sure where to start, I would encourage you, please go ahead and click that link below. Get your free personalized 5-minute retirement plan video. I'll look at your specific numbers, send the results right to your inbox, and in the meantime, I'll see you out there.